Welcome to Asset Block's Business Owner Edition, because wealth creation is different for Australian business owners. Today, we're going to be talking about dissecting our best investments. Part 1. This is a series, and there'll be part 2, 3, etc. So be on the lookout as we release more. But before we get started, let's cue the disclaimer.
Charley here from Asset Blocks, and I need to let you know that this is a disclaimer. Grant, myself, and the Asset Blocks team are in no way, shape, or form qualified to give you personalized financial or investment advice. We're merely sharing our own experiences and opinions, but you should absolutely seek the help of professionals before acting on anything you hear in this podcast or on our brand.
Charley, this episode is super important to me because if you see that other people have done something, you realize that it is highly possible for you to do it, and highly probable. Do you have any stories about like mentors or networks that really sort of prompted you forwards?
Yeah, absolutely. I was involved in a mastermind group many years ago when I was starting a digital marketing agency. And I look at that and go, when I was at the event, I was very fixed in what I thought was possible in my agency. And I was very fortunate to hang around some people that were doing things very differently. And when I got to look under the hood and see what they were doing and kind of swipe and deploy their best ideas into my business. Of course, taking on my own risk, I accept that when I use someone else's ideas, it's my responsibility. Heads up for today, right? I'm sharing things, but it's your responsibility what you do with it. Don't come back to me on it. But it changed the way I ran my agency and ultimately allowed me to go a lot faster. It changed the trajectory because all these new opportunities started to become things I could do within my own business. And I think investing in property is the same.
Yeah, and it's interesting because you can use that power of the network within your wealth, but also your business, because to your point, you can learn from others, you can ask them questions, but most importantly, you can kind of see what's possible, right? Like if someone's gone and made $1 million, you go, oh, wow, that's completely possible. And I think the key underlining message to everyone listening to this is we want you in our network. We want you as part of this peer group, and we really want you to see behind the curtains of what Charley and I have achieved so that you can go, oh, wow, if these two idiots can achieve it, I can achieve it. So if you're an Australian business owner who's sort of looking on the edge of going, I'm going to start wealth, or has started and just still going, well, what is possible? Then this episode is going to be perfect for you. And if you do want to be part of the discussion, ask Charley and I any questions, or even ask questions about other investments that we've done, etc., head over to Facebook and join the Asset Blocks Facebook group. I think it's called Asset Blocks Community, and have a conversation with us. We're over there and we ask a lot of questions ourselves as well. And if you do enjoy the show, be sure to subscribe or even share it with someone else who it could help out. Now, without further ado, let's get into the episode. So today's episode, Charley, you are going to be in the spotlight. You are going to be the one talking about your investment. I'm going to jump in on part 2. So I'm not going to waste any time on this. I'm going to go straight for the meat and potatoes, or for the throat, or whatever people talk about. So before we dive directly into the deep, dark details of what asset did you go, what was the price, and all those kind of things, first up, what type of asset did you go with? Because there's a myriad of different assets. And then why did you deem it one of your, investments that you'll be covering today?
Yeah, great question, right? I must admit I'm a little bit nervous on this one because it's really putting yourself out there. One of the things I want to achieve with this podcast is transparency. There's a lot of people pushing things online or in the wealth space, and they allude to their success, but they never really talk about, well, what do you have under the hood? How does it work? What results has it gotten? Yep. And one of the things I've known from business for a long time is I've gone to work with businesses I've thought were tremendously successful. And when I've seen behind the scenes or under the hood, I'm like, they're going to be lucky if they make payroll.
Yeah.
Driving a Porsche, not sure if they're going to be able to make the payment on the car or can afford to put fuel in it. And this is a really common story, and unfortunately common in the wealth space. There are a lot of charlatans out there, although I will say business as well. So in this episode itself, I just want to make it really clear. I'm making, this is what I have done. It's a personal thing. I'm by no means saying that you should copy me without getting help or advice. Or what I do hope though is it spawns you to question what's possible for you, and then you seek professionals, you seek other people that can help you on this journey. Because I know when someone showed me and I saw what was possible, it changed everything for me. It really, really did.
Yeah, and I think that's really key for everybody, right? Because we've all sort of sat on the outside and looked in. We've all been on the outside of that house looking through the window saying the party on the inside's better, and I just wish that someone would come and open the door for me. And so I appreciate yourself and Bianca for saying, hey, we're willing to share some of these details, because some of the questions I'm going to be asking you, you are going to be lifting your skirt today.
I'm in for it. I want to change it, right? Too many business owners are going broke. Too many people retire with nothing. This is something I want to change. I think more of us can achieve more with what we're doing in business. All right, so the question you asked is like, well, I'm going to start with the why. So this was my second investment property I'm going to be talking about today. Why it was so important to me is that it very much aligned with my wealth goals. So I looked at what we discussed in a previous episode about what we were trying to achieve. At this point in the journey, I had a bit more clarity on that. And my goal with this second investment was a bit of what I'm going to call a hybrid. I wanted my cash flow to improve as like the primary thing. So after purchasing this property, I wanted the money to come into my bank account to be increasing every month, not decreasing. And then the second side of that is, because this was an earlier purchase in my portfolio, is I wanted some growth with that so that I could keep buying properties as well. So I just want to dispel a myth really quickly here, is like there's a camp theory, you do cash flow or you do growth. There are certainly opportunities to do hybrids where I've got good cash flow, not the best you can get, but good, but then I've also got good growth, not the best in growth, but very good in growth. And I've kind of taken the best of both worlds here in this investment.
Yeah, and it's like hedging your bets, especially because Asset Blocks is targeted to Australian business owners, right? Because you have businesses, you don't always want to be looking over your shoulder saying, am I getting the greatest growth? Is it peaks and troughs within the market? Do I have to sink more money into it because it's negatively geared? But on the other side, if it was just cash flow heavy, you become too responsive to the markets, right? Your property might go up, it might go down, but you don't have the leverage within the equity that increases. So if anyone's a business owner out there, like that was one of the biggest things that I look at in these types of investments, is saying, okay, like how do I help me as a business owner not jeopardize my business so I could focus in? So the hybrid approach that you've taken on this makes complete sense around cash flow, number one, and then capital growth, number two. So like, why were you looking for this type of investment? Were you looking for like freedom? Were you looking for options? Is it because your business wasn't going the way that you wanted it to go? Like, why did you start looking at investments at the root like level?
Yeah, well, kind of the opposite. Business is doing well, and what had hit me was like, well, what am I doing with it? I've developed a surplus of cash month on month in my business. My business is going strong, and now I'm looking for ways to take that cash and put it into vehicles that give me more options. So again, it's like, I know in PAYG community, a lot of people will focus on retirement. Not so much for me. Like, I just want to develop good cash flow assets that, again, do have some growth, but then I can have some flexibility within my business as well. So if I want to use the funds from this property, the cash flow for it to fund this podcast, I can.
That's a very good point. So jumping a little bit into the details. So property, talk to us about sort of the initial sort of parts, like some information like when did you buy it, what's the size, location. You kind of touched on sort of how long you've had it for. Any details around like the initial step, and then we'll get into sort of the cash flow and how is it going now and stuff like that just in a moment. So just imagine you were going back a couple of years and you were looking at this thing and you were doing your spreadsheet and going, what's this going to cost me right now? Walk us through that.
Let's go through it. So this property I've had for almost 2 years now. We're recording this in about the start of Feb 2022, just for a timestamp on this. So I've had it almost 2 years now. The property is in what I'll call the Newcastle region of New South Wales. So for anyone that isn't familiar with the map, it's if you know where Sydney is, it's probably about an hour and a half, 2 hours north of Sydney, roughly. I must admit I'm not great at Sydney geography, so let's just say roughly.
That's all right.
So that's where it is. And then this property is a bit of a unique type when we look at it. It's actually what is known as a triplex, which means there's 3 tenants come with it. But I want to unpack that a little bit more for understanding. This is a house that has 2 levels. So there's a level on top and a level below, and then there's a tenant that lives on the lower level, a tenant that lives on the upper level. It's just a really big house that's got 2 kitchens, 2 laundries, 2 of everything. In future, that could be just made into one big house. but for the time being, it's set up in a way where 2 tenants can live in it. And then it also had something called a granny flat or a unit in the back of the property because it's on quite a large parcel of land, so that the third tenant is in the granny flat component of it or the unit component of it. So it has 3 tenants that are on the one property. It also has 3 income streams. So what I really liked about this one was that if anyone was to leave, I've still got 2 other tenants. So I'm not running the same vacancy risks on the property. So I really like that. I like, again, a bit of diversification in the properties. I like that it's a standalone property with land. And then I love that it could be reutilized into something else. So, a big family could rent it. Maybe they really have a nana that wants to live out the back and they've got 4 kids they want to live in the house, or we can rent it out to 3 separate tenants. Like, it's got some versatility in it, which I really loved about this. And again, was not something I knew you could even buy in Australia before talking to people in this world. So that's the layout of what the property is, and hopefully I've explained that well enough.
Yeah, so essentially it's got good parcel of land. I would assume probably greater than 600 square meters or something like that.
It's roughly 600 square meters.
Yep.
Flat block.
And it's good. And essentially you've got 3 dwellings or house components on it that you can bring in revenue from.
Correct.
And you kind of touched on it. I am curious. Did you just go realestate.com.au and just go, I want a triplex, mrrealestate.com.au. Please show me where to buy. Did you know this? Like, have you lived there before? Have you seen this place and just gone, this is going to be great? Like, because it's a very specific thing. Like, it's like a parcel of land, 3 income streams on this parcel of land in the Newcastle region. Like, was a question. Like, how did you figure this place?
Well, so I've never been to Newcastle at all. I feel horrible saying that, but I think one of the biases we have as people is like we're very biased to our own area. So like I feel very confident buying houses around where I live, but they're probably not the best investments. And that had been made very, very aware to me. I look at it and go, I have a very, very specific set of skills in media and online. Like if someone wants to build a podcast, or if we want to do some sort of digital marketing, like I'm the guy. I'm very, very confident. I've got a lot of skill and training. As for picking property locations, none. I would be guessing. The good news is I'm aware that I would be guessing, so I'm not going to guess. So there are professionals you can use called buyer's agents that will help you pick locations. So I use someone who will probably come up many times on this show itself is I used Goose or Gabby and their company Dashdot, which helped with the buyer's advocacy components. Just was really good. There's obviously other people on the team as well. Do we want to go into that now, or should we save that for a later part?
Yeah, we'll save that for a later part, and because I'll dive into some more financing and how much you paid for it, etc. So it was interesting, right? So when you aligned to your wealth goal, you said, "Yep, I need to grab another property," and this was about 2 years ago. What was the first thing you did? You just hit up Goose and Gabby, or was there like a bigger process? Did you try and find out if you could fund it? Did you set a budget first? Because we haven't even talked about how expensive this place was. Like, what was the sequence of events that you went through in order to say, this property makes sense to me? Like, was it buyer's agent first? Was it, can I get the money? Was it, what's cash in the bank? Like, what was that sequence?
Yeah, so my first property, I think you could just describe as carnage. Didn't know like all things, right? It's like it was a whole new experience. I'm like, when do I talk to this person? Do we need this? It was a lot of finding my feet. What's a conveyancer? Like, I know some business owners are listening to this now going, yeah, what is a conveyancer? No, I didn't know either.
You'll go through it.
Anyway, the point being, this was my second investment, which I mentioned earlier. So I felt more comfortable in the process. We kind of knew the process of buying another property at this point. Yeah. So the way it kind of works is step one is I had a conversation with my broker after my first investment was done. And I said, look, we've done this. What's possible for me next? So broker was Aaron, and who we've already recorded an episode with, I think will be very helpful business owners. I spoke to Aaron and I said, look, what is my borrowing capacity? So if I wanted to buy another investment, like what are my options? And Aaron very graciously made up a really good spreadsheet for me and a video. And he said, look, this is what you can do. And this is how much you could borrow, how much you would need to contribute if you did it. And I took that information and I went over to Goose and I said, look, this is the lay of the land. My my home, this is what I got. This is how investment number one is shaped up. What can we do next? And then Goose being like his, and Gabby, I will say, it was definitely both of them. I will often just go to Goose because we're good friends and talk often, but there's a whole team at Dashdot that do an excellent job. What tends to happen from there, though, is that they will get a bit strategic in options. Yep. And again, it's my responsibility. Like, I'm the one saying yes or no. I'm not putting this on other people, but being that Goose and Gabby were buying properties every day of the week, doing all their time is spent on research, I'm going to back them before I back me.
Like most people should.
Yeah, so Goose developed a plan based on the borrowing power I had at this point and said, look, these are the options. And then we set a range. So we said, Charley, look, in this case here, you could borrow up. And I think I could borrow about $1 million at this time.
Yeah.
Because so anything up to $1 million we can do. I'm going to go out and search, and I'm going to effectively try and find good value. So he said to me, and this is a really important point, he's like, I might come back to you and we might buy 2 at 400, or we might buy one big one at $1 million, but we want to find where we think a good opportunity is. We're not just going to spend your maximum. Like, you want to make sure you're getting something that will, over the long term, serve the goals you have here. And I told Goose the goals I had that were referenced earlier here. Like, I wanted him involved in going, like, I'm trying to get to this wealth goal. In what order do the pieces need to go? And noting that there was going to be more investments we do later. So this one was growth and cash flow, where down the road there are future ones, which I'm sure we'll dissect, where it's like I've gone more cash flow heavy or I've gone more growth heavy, depending on what my portfolio needed at this point.
And that's the perfect segue into my next question, which is, how much did it cost you? So you've got budget of $1 million. Obviously, you've got multiple options, right? You can go and buy 4 houses at $250,000 each. You can go and buy a massive house at $1 million, or you can do like 2 for 500. And you just said, Goose, you figured this out. You helped me. These are my goals. You helped me on this journey. So he's come back, and you've seen triplex, Newcastle region, 600 square meters. Like, how much was that house? And walk us through sort of that upfront process, if you will. Like, what was the deposit you had to put down? So the total price of the house, deposit that you had to put down, and then we'll dissect a little bit more about what were the hidden costs around conveyancing, stamp duty, and all that kind of stuff.
Yeah, so I just will mention, one of the good things about not maxing out your borrowing capacity is if you know you want to do future things, like this isn't the only property you're going to buy. If you only spend, let's say, half of it, you know you're going to have more capacity down the road for the next thing. So I don't think the attitude of like, got to max it out is max. Yeah, if you know that this is like part of a bigger picture, it's like you think about it differently. So this property we purchased it for $620,000 plus costs was the price of this property here. And that's Australian dollars for anyone that is potentially listening from elsewhere, but of course for Australian business owners here.
Okay, so it was 620, and what deposit did you put on?
Yeah, so this is where this story gets a bit interesting, is we didn't necessarily realize that in certain lenders, which I won't name the lender just because I don't want to defamate anyone at this point, but definitely one of the big 4 banks. Yeah, they don't like triplexes. So they looked at this property and they're like, oh, look, you want to borrow this amount of money, which I think, let's say we wanted to borrow 620 grand. They're like, it's too risky. You got 3 tenants. Like, I would have thought personally that if you had more income streams, it would be less risky.
Yeah, one person could leave. You still got 2 incomes coming in whilst you're replacing the third, like as opposed to a house where if one person leaves, it's empty.
So turns out opposite is true in this case. So when we went to go to the bank, they said, look, you can buy this, but instead of a 20% deposit, you've got to leave a 30% because we need to protect our risk. Now, and the scale of this, like if you're, let's say 620, like it was on a 20% deposit, it's 120 grand. On a 30% deposit, now all of a sudden we've got to come up with $186,000 for the deposit. So I will mention this at this point because I feel it's really important. This is one of the reasons that I feel business owners have a unique advantage, and why the type of thing I've done here would work best for a business owner is because I was in a situation because I have a good business that I was able to come up with that money.
Yeah.
If you were someone in a PAYG, and again, I'm not saying it's worse, it's just different. You have to play the game differently. To come up with that amount of money would have been very difficult if you're on a fixed income and couldn't quickly come up with it. You would potentially have to borrow it off family and friends or something to do it.
Correct.
Yeah, where in this case, I looked at it, we'd purchased the property, I knew I had some time till settlement, and I knew we had good reserves and things going on, so we were able to kind of do that deal in a unique way. It was not ideal at all because we weren't expecting that. I didn't expect that to happen at all. I, again, would have perceived it was less risky, but in the eyes of the bank, this was the finance we had to take to be able to purchase it because there was not other finance options for us at this point.
So if you couldn't come up with a 30%, would that have just like, were you able to get out of the contract? Like, were contracts signed already? Were they offering like maybe like a lender's mortgage insurance, which is, hey, if your deposit is less than, typically it's 20% on a property, the banks will charge you an amount for insurance that they will put on your debt. Do they offer you any other option, or was this a do not pass go, do not collect $200, you must put 30% deposit down or otherwise you're forfeiting this house? Or, well, actually, if you're on contract, you might actually have been forced through it unless it was subject to finance.
It was subject to finance first.
Okay.
So when in the sale of a property, we did have a subject to finance and pest and building and all that, which I think is a great thing to have, right? You don't want to buy a house and then find out it's got termites, or find out you can't get the lending and then go, well, what do I do now? I was probably uneducated on LMI at this point. I didn't truly understand it, and the banks will love to sell you stuff. Like, that's what they're in the business of. Like, let's get real, is they want to sell you products and services. That's what they do.
That's where they make money.
Yeah. So when we looked at that scenario there and looked at it, we just elected to come up with the 30%. But I dare say there were probably options for insurance, but it would have increased the costs of purchase dramatically. Probably like LMI, when you're already on a risky product in their eyes, they're going to put a premium on it as well.
Definitely.
Yeah. So I looked at that and said, well, we're just going to ride this, and eventually at another point we'll potentially refinance it. Or the other side of it is if you leave a bigger deposit on a property, like, and this is the positive, it just makes the cash flow more positive.
It's so much better.
Yeah, there's like less debt on the property, right? Because you own more of it because you've left a bigger deposit. So it's like, well, you get more cash flow out of it anyway. So I was like, let's just do that.
It's a win-win. So it's a $620,000 property. I'm going to use a term called LVR, which is loan to value ratio. So you've got 30% deposit, which is what you have put in, and the loan's going to be the 70%, which is 620 minus 186. So what are the costs outside of the $186,000 deposit did you have to sort of front up to purchase this property, just so everybody is aware of it?
Yeah, people often miscalculate this one. So I've done it on the calculator and double checked it. But the big one for Australians is stamp duty.
Yep.
So when you are doing your maths here, like, stamp duty was $26,402. So $26,402. That's not a small amount of money to have to come up with. That is just a donation to the government. The government isn't involved in this or getting anything for that. It's just the tax. So you have to come up with that as well. Now, I realize some banks will actually let you put that in the loan and all the rest of it as well. There are options with that, with LMI and all the rest of it. But in our case, this is cash we had to come up with again. So if you start doing this maths right now, you've got 186, and I've already had to come up with another $26,000. Like, I needed $200,000 of capital just so far.
212 already. And then on top of that, you've still got your conveyancer, your building and pest, and we'll talk about like Goose and Gabby in a second as well. So, like, what was your conveyancing, legals, and like, did you get building and pest inspections done, etc.? Just like these other, and was there any other fees as well, sort of stacked on top?
Yeah, so conveyancer and pest and building all in come out at about $5,000.
Okay.
Yeah, so I'm just going to group them as well. There was some miscellaneous things, like we had to get potentially a trade to like look at a roof, or a plumber to look at a roof and check it out. Like, there's a whole bunch of things that go into that process. And maybe we do a deep dive of what goes into due diligence on something like this at a point as well. We also had to get someone to inspect the property, which was done through our buyer's agent, Dashdot in this case. So there was their fees involved, which that was $12,000 at this point as well.
So at this time, the purchase cost that you had for this property was I've got my calculator out and doing it right now.
Fantastic.
Was $229,000, which includes conveyances, building and pest, the deposit, the Dashdot fees, which is the buyer's agent, the deposit, etc. And what was the settlement? Was that like 30 days, 60 days, 90 days? Just so I'm aware of like what you were able to do to get that $230,000 essentially together for the day of settlement, which is when you take the keys.
Yeah, so we had a 45-day settlement,
Yep.
roughly. Don't quote me on the exact. Sometimes they move around, but that was the terms of it from there. There was a whole bunch of running around in the background to like do the finance due diligence, the pest and building, everything like that in this time. And again, just to fill people in, you do the pest and building like after you do the contracts. So like you would sign things, you put in your terms of like subject to finance potentially, subject to pest and building. You might have other terms you need, or you might need a longer settlement or whatever it is, but the contract basically sets the terms of the sale and everything that goes into it. I will also mention there was probably about another $5,000 of like miscellaneous things to do in this time as well, like paints, door handles, fixing a door I think we had to do, but there was like some property maintenance that I just allow $5,000 to $10,000 on every property I do that there's going to be things to fix up.
Same. I reckon most of the properties I've had has had a hole in a door. Something's always wrong with the door. And so
I don't know what people do to doors, right? It's like,
understand.
I'm not replacing doors at my house this often. Like anyway.
And they're always in like obscure locations on the door as well. Like it's not like someone's head's going through it. It's like weird locations. Okay, so now what the audience at home is always interested. They're like, stop telling me. We understand that you've spent like $229,000 to buy this property. So let's dive into what does it look like from a cash flow perspective. Now we're going to lead with the good news first, which is like, let's talk about income. Like what does it bring you in? And if you know what it originally brought you in and what it brings you in now from a rent perspective across all those 3 tenants, great. If you don't, just what does it bring you through now? And we'll start talking about expenses. Like what does this thing cost you to run every single month?
Yeah. So I do you want to? Actually, I'll go there, but I just want to make sure we come back and talk about the time aspect of this one as well at some point.
Got it. Yep.
Yeah, so we'll cover that momentarily after this, but we'll go to this now. So what's the rent? What do we get on the rent to this today? So this property rents all 3 combined, so all 3 tenancies for $910 a week today. Now the rent has gone up $30 a week, so $10 in each unit, if we're going to call it a residence, in that time as well. So if it's $910, it was probably $880 to begin with, and then that it's moved to there. So, and I've got this written down. I'm going to look over at this sheet. If you were to work out the yield on that, which is something that people are always interested in, is that today on the purchase price, that's a 7.63% yield that it gets from the property.
It's a great yield.
Fantastic, I would say. I'm quite happy with it.
Definitely. And so that, I'm just doing some quick maths on that, times 52 divided. So that's $3,945 a month that's bringing in. Because the reason I relate that back to a month is because of the expenses. I'm going to try and see if we can't round them out to monthly as well. So I can do some quick maths on where we get to from there. Now,
do you want me to do a run through? I'll just run it through right now. I've got this all in a sheet, and I know on a future episode we're going to talk about like tracking this stuff, and we're going to make some sick templates and things for people. So $3,943 is the actual grant, but we'll call it $3,940. So let's go through this in the way we've got it set up today.
Yes, please.
We have refinanced the property since, and we've restructured things differently. I will mention here, I've spoken about the initial stuff. We were able to refinance this property at 80%. So get a 20% deposit and get some of our cash back at a future point.
Awesome.
But for now, I'm going to run through like what it actually is today. So rent, $3,940. The interest we pay on our loans every month is $1,222. So that's just what we pay in the interest. The interest rate is about, I think it's, and I'll give you that as well because I think it's important to share it, is 2.99. So it's 2.99%, we'll call it 3. Our council rates and water rates on this property are $455 a month. So that's like, again, we don't pay the water bill, but we pay the water rate that comes with it. And then the council rates are on us as well to pay. The tenant doesn't pay that. Insurance is $168 a month, which we've just taken the annual and divided it by 12. Our maintenance, which this is just a buffer we put in, we allow for these door replacements for whatever reason, is $208 a month we allow in our maintenance. And then we've also got an estate management fee. So we have someone managing this property. We're not managing it ourselves. Like there's a real estate agent local to the area who goes in and inspects it every so often, looks after the tenants, makes sure the property's running well, lets us know if it need anything. And of course, we want to support that as well, which is $306.
So that would sit about a 7.5% on your rent.
Yeah, I think 8% is about the standard these days. So that would be correct on that one. I think we actually have multiple with this agent so that they're quite happy to do good rate.
Perfect. And do you put like a buffer in at all before I start asking you a little bit more about the loan that you've got in the refinance?
Yeah, so I put in a $42 buffer. I don't know why we do it that specifically. I think I set it at about $5,000 a year. And if you divide that, that's the amount. So I just allow that. So if a hot water service breaks down or we need to replace something, we've put that in. But on a monthly basis, just to go through that, and you can see I've allowed some buffers in this for maintenance and just odds and ends, is that we have the costs at $2,401 a month. So there's almost $4,000 of income. Yep. So $3,940, and then the costs to run this is $2,401 per month. So that's gross, all gross to this point.
And so what's that net profit, just so everyone at home can do the calculations for themselves?
Yeah, so net profit on this one per month is $1,542 a month positive cash flow.
Perfect. Isn't it fascinating? And was that positive from day one? Like obviously we're talking about current figures, which is, to your point, 2 years on. Was that positive the whole time, or did you have it negative at any point in time? I know that your goal was good cash flow when you first looked at it. Just want to make sure.
Yeah, see, this is an interesting one. So I'm going to say no. I'll explain why. Okay, just work with me on this. When we purchased this property, we had some one-off expenses, like the maintenance, like the what else would it be? Like any of the other fees and costs associated with running the property, fix up things. They're deductions in the first year.
Yep.
So when you look at this, we bought this property, I want to say it was in the first half of a financial year. So there was only so many months in that year and we had these big deductions. So in the first financial year, end of financial year of running this property, it actually ran at a loss with the fixes and everything else because we're only accumulating like $1,500 a month, right? It's not a huge amount of cash flow to cover these things. But in the second year, it's all good. Like that is something where I'm talking financial years, of course, here. Yep. But when I look at that, it's like, okay, some of the initial costs we spent to get into the property become deductions, which is great. There's also things like depreciation and insurance costs and loan costs that are deductions. When we got this into the second financial year, though, we didn't have those costs again. They're all taken care of. So that's more of like once you're through the getting it set up phase, this is the like reaping the reward. And I must admit, this has been one of these investments where it was like a bit of work at the start. So time at the start of this, and I know this is a future question because, well, we do good prep on this podcast, but I'll mention it now. Time was a lot up front. So we had to, do the pest and building, do the insurance quotes, do the fix up of these things. And then once settled and tenants were in, it's been like low key, man. Like we just set and forget type stuff, which has been really great.
And I think that's a really important point to make when people are doing their budgets and they're looking for a cash flow positive property, which is what we primarily focus on, especially as business owners, because I just don't want to be worrying about putting money into a property, or if a hot water system breaks, which I've had that break. It's $2,500 it was for me, and plus to remove the other thing was probably more about $3,000. I just don't want to go looking and go, oh, where am I going to get that from? Right, I want to sit in the property. And so making sure that people at home are aware that usually the first 6 months to 12 months, you will have these things, right? Like your first 6 to 12 months might not be cash flow positive. It might not be negative, but just factor that in, that sort of some of these real benefits, to your point, Charley, is into sort of year 2, if you will, and beyond, especially based on financial years. Now, I'm talking about perfect buffers when I'm saying this. Like imagine you buy it at the start of the financial year, end of the financial year, etc. Like that's just really what people should consider.
How's this any different than staff, right? You hire someone, they're crappy at what they do, you train them, they get good, and then after a duration of time of running more expenses into that staff, getting them a computer, whatever it is, as they grow in skill and develop, that's when they become more profitable or more set and forget because they've got skills and can be more autonomous or take on new things.
Now, before I jump onto the time question, there is one little point I'm going to ask, if you're okay to share it. The loan. So you mentioned, and I'm going to merge both concepts together. So you mentioned that it was running you $1,222 a month. Is that principal and interest? Was it interest only at the start? Is it now principal interest? Well, have you changed it? And then whilst you're answering that, dive a little bit deeper into that refinance that you shared, because I assume over 2 years, especially with Australia's property price and how it's gone crazy, you've had an increase at some point as well. So very long question, but take us through that journey just so I don't keep interrupting.
Would you believe this property's actually been refinanced twice now?
In 2 years.
2 years, I know, right? Thank you to my broker who helps me a lot. Cheers, Aaron.
I do love that.
So let's just, I think this is such an important question because this was a huge gap for me. In business, I didn't understand lending because I didn't have this type of lending. I'm not buying buildings and selling buildings all the time in what I do online. We have different things we deal with. Where here, this was a bit of a black hole for me. So what occurred is that I was limited with financial products to buy the product, to secure it at purchase. So I had to take the loan I could get.
Yep.
Now, it was not an ideal loan, but the great thing about finance is you can refinance. It's actually really uncommon for an investor to get one type of finance for a property and that's it. That's very, very uncommon. So in normal circumstances, I'm led to believe to now only through hanging out more investors is most people are refinancing every few years they're refinancing something, or every 5 we'll say. It's common to do that because better products come out, your position changes, you're going to want to do things with your finance because the finance component is huge. So initially 30% deposit, principal and interest loan. They didn't like interest only for this as well, just as an FYI.
I was going to say, I don't think so.
It's funny in hindsight, but I was like, they pretty much saying they don't want to lend for this property. That's what they're doing. They're putting up the barriers because they didn't want it on their books, or they're going to take a premium or de-risk it. So after about, I'm going to say 6 months, the property we'd had it a while, we were settled, we had all our tenancy and everything was running smooth. We actually refinanced that with a different lender because they were much happier with that type of loan. So we moved from one to another, just another Big Four bank. That Big Four bank, we did a 20% deposit and an 80% loan, and we just put it on principal and interest again. So we had it on a P&I loan, that's called. Now, in doing that, we got $60,000 cash back because we went back to the 20% deposit, and I actually used that $60,000 to buy another property down the road, which I'm sure we'll dissect that investment at some point. But that's why I moved it back to 80%, is that it was just, I was holding so much of my capital in this property, and I was like, well, why? We don't need to do that. It's cash flow positive. We can utilize our capital better. In recent times, though, what I've actually done is change the loan again. So we had to refinance the loan to make it interest only. And there's a reason for this, which I'll get into. Actually, we'll just go there now. Like,
we'll
why
not? Do it.
So we went interest only. So just to break that one down, so rather than paying principal to the bank every month, I've put it on interest only for the next 5 years. And I'll describe why. Number one is when you have a loan on interest only, that principal payment now you get to keep in your bank account. So I want that cash available to me so that I get to decide how it's used. If I want to pay the principal off, I still can, but I would just prefer to have the control of it so that I have options. So if I do want to use it on business this month, I can. But then the other side of things, if any maintenance and repairs were to come up, I've now got a lot more cash flow disposable to me to deal with that ongoingly, which I think is a really, really handy way to think it. It's less risky if you have more cash flow available to you to handle situations. So completely. That is my view. There's also something in Australia called offset accounts, where you can actually have an account tied to this loan. And if you have money sitting in that account, the bank only calculates the interest based on the net result of those two accounts. And we'll probably talk about them later, but they're such a powerful tool because if you, in this example, if you had a loan we'll just use a rounding example. If you have a loan for $500,000, but you've got $100,000 in the offset account, well, they're only going to charge you interest on $400,000. So there's just so many advantages to having more flexibility with your finances like that.
And also understanding that as well, which is where I know through my investment journey, these were the conversations that I've researched, but also Aaron's given me some deep insights into of just going, right. So to your point, if I just held on to and didn't, like if I just had interest only, held on to the principal in my hand, put it into the offset account and just left it there, right? So I'm not paying the interest on the loan because it's obviously offset to your calculation of the $100,000 in cash sitting there. I only get interest on $400,000. I'm like, and then if I did want to pay it down, okay, I just pick it up and just move it into the
pay
loan
down.
account. Like, well, who doesn't explain these things? Like, and I was like, that's just so logical, as opposed to, is it because I'm just that bad at budgeting that the bank just has to say, I'm going to take the principal from you?
Yes. In summary, yes.
And so, like, when someone explained that, which was Aaron, I'm just like, huh. It's like the most obvious thing of just going, yeah, okay, I completely get you. And so when you did the first refinance, it sounds like it was the same amount. So
Correct.
it was a 620. Okay, so the property might have gone up. Just for everyone listening, one of the things that I mistakenly did in a property was I had a fixed interest. Because on your second refinance, did you take any money out? Because in one of my properties, I got a fixed interest only loan, which means that I cannot refinance without paying some fees to get out, etc. for, I think it's about 2 or 3 years. Right?
Do you know what's so funny? I think the marketing of fixed rates is done so well because everyone's like, oh, you're just locking in your rate. No, you're locking in your loan. If you need to refinance or change anything, yes, they've locked in the rate, but there's also immense fees. Like I've heard of people having to pay like 30 grand to refinance a property because they broke the contract on their fixed rate. It's like, oh, that can hurt.
You're like, oh no. And so the second refinance, did you refinance? So you moved to interest only. Did you pull any money out or you just kept the same amount?
No, I've just kept the same amount. And the reason is I'm quite happy with the cash flow position of this property. I could have absolutely taken more equity out and bought more properties, but one of the effects of that is if you increase the loan on a property, you decrease the cash flow. So if you're thinking about the bigger goals, which I continually think about, is like this property is serving a really good purpose. I don't want to mess with that and increase my risk by massively increasing the loan and decreasing it. Even though I could buy more properties with it, it's counterproductive to what I'm actually trying to achieve. So I prefer to think of it this way. And maybe I'll use some leverage from it down the road, but I'm not in a position where I need to do that. So I'm not going to increase my risk.
Yeah, and I think everyone's going to also be aware of like capping out like borrowing. Like you only have, so based on the income that you get from your business, right, or your partner as well, there is only so much that you can borrow. And so the more that you refinance, the more that you sort of pull out, you keep pushing up against that total amount that you can borrow as well. So the other side that I know, Charlie, you and I speak about a lot is, well, okay, is that going to be the right use of that debt? Is that going to help me move the needle in the direction that I want to move it in order for me to achieve my wealth goals? And so there's a whole heap of considerations when it comes to that. And I know that we're going to do another episode on sort of how you can push and pull these levers, but it's just all these considerations that we need to understand. And
I'll just put in one more there before we go there. I'll go a few more into this. You can always refinance later. I can do that at a future point if I need to or want to use that. It's just for where I'm at right now, I'm fine with that. The things are going well, but I know you've got deeper questions on like what's it valued at today and everything like that. So I'll go.
You can just continue.
I will finish this rant.
Yeah, you just continue.
Okay, so that's how we've done it. So be refinanced twice. We're now on an interest-only loan just to have more cash flow coming into our pocket. We also had a valuation done. So something I'll highlight here is that if you are into property and doing property investments, is you're probably going to want to get a valuation done at least once a year. I like to do it twice just because I want to know what the banks are valuing my properties at, because it can help me decide what my next moves are. So I've had this valuation done in the last month, and the property today, ready for the drum roll? I'm just holding it off because I know people really want to hear this. So I'm just
and
delaying.
catch us on the next episode when Charlie does.
No, let's just go there. So the value of the property today is $880,000.
Increase of
260,000. So we purchased it for $620,000. You then have to factor in your stamp duty and costs and all the rest of it. And then today's value is at $880,000. And that's a bank valuation. That's where the bank has come out to the property, done an inspection, or they've used a valuation company. There are businesses that do that, and they've assessed that. And this is what I think is really interesting about the bank valuation. When they do a bank valuation, they're like, what could I sell this for today?
Yep.
So it's always a little bit under because, people in the market might be willing to pay a little bit more, where the bank's just assessing this from a risk point of view. So it could get more on the open market, but I'm happy to be conservative and take that valuation. But let's be real, the $260,000 uplift in, let's say, 2 years, I'm good with that. I'm really good with that.
130 a year. Now, do you consider that as income, or do you just see that as my personal wealth is increasing?
Yeah, so I track those separately. I think I track, personally, I've got like asset net worth, what is net worth? So it's like if I sold everything today, got rid of the debt, and I stacked all the cash together, how much would be there? And then I track cash flow as its own thing. So I kind of think about it like it's a balance sheet and a P&L statement or a cash flow report. And I view it that way.
And we are going to do an episode where we deep dive into doing that for wealth. Because it is so important. Because I've spoken to people before where it's like, whoa, made some money. And I'm like, yeah, I guess. But no, like it's there, but it didn't come into your bank account. Like it's not liquid, right?
Well, the other side of this is tax, right?
Yeah.
So if you sell it, you've got to pay tax on that capital gain. Where if you don't sell it, like that's sitting there right now. So I'm very, when people do these calculations, I think they lie to themselves a little bit. Like I'm fully aware that 260 grand of gain is not all mine. Like there's tax to be paid on that.
Exactly. So 2 years in, what do you sell it now, keep it 260, pay tax on it, and go and have a great trip to the Bahamas? Like, what's the future plans? What is the strategy for this one?
Yeah, so again, this is why we talk so much about not having things that you have to keep putting cash into. So in this case here, the point I really want to make is like this property pays me $1,500 a month to hold it. Like that's gross profit. I won't, taxable incomes and whatnot. I don't have to rush to sell this. If this was a huge renovation product, so let's say I did a massive renovation, this property's negative gear and it's costing me $1,500 a month to hold it, I probably would be in a rush to sell it or move it on because this is now a liability. But when something like this has happened where it's putting money in my pocket every month and there's some good growth, like I'm happy to wait. I'm happy to have this thing be a long hold in my portfolio. And that's the intention of this one. Like this isn't something I'm going to be flipping or selling anytime soon. Like I actually hope that this will just be one that's in perpetuity, that's just we hold for a very, very long time.
It's an interesting one because I think, I know you and I talk about this quite a lot around, well, what's the long-term strategy of property? And just, it always seems as though just buying and just holding is like the greatest strategy ever. It's just you acquire it for the long term, especially with property prices, as most people would have heard the saying of like, yeah, property continues to increase, safe as houses, etc. But there's
I'm going to push back on that. I'm going to say that it's just it's a strategy and a tool in a tool belt. It's one that we've both utilized well and is great for our circumstances. But I've met some developers, I've met other people, and it's like that recipe's right for them. So it's different. Now, I'm much biased as you, as I'm like, why would I do anything else if I can do this? I think this is awesome. Like I'm fantastically in this type of thing. But I just want to preface it because I think that like, there are times when development can be awesome. There are huge gains you can have with that if you know what you're doing, or other things as well.
And it definitely comes back to the concept of asset blocks, because you and I have talked about at different points in your investment journey of when would you sell down to pay off debt? When would you move to your point, developments, land banking, etc.? Like when do you utilize different types of assets at the different stage of your journey, depending on what you're trying to achieve at the end of the day. So you're completely correct. So I'm going to keep asking you these questions just to see if you're starting to sell some down. So we've walked through a couple of the challenges. I'm going to deep dive on any others that you haven't sort of touched on in a second. But before we get to the things and the problems you hit, like the issues, risks. Risks are the things that you didn't know or that you weren't facing at the time, but you knew that you potentially could have hit. Right. So this question is going to be split into two parts. First one is, what risks were you aware of when you were going down this property journey? And then what risks were you not aware of that you now are aware of when you get into different property investments, et cetera, whether that's regional based, the asset type, et cetera. So two questions. And then after that, I'm going to get into the issues that you actually ran into that we haven't covered already.
Yeah. So this is a really unique question. Like the obvious one is that we didn't expect the lending. We did not expect the lending challenges. That was the biggest challenge of this whole one, was getting the finance all done and dusted. The other risks that we just could run in general is like you could buy a dud. Like what if the pest and building guy is having a rough time in his life and actually it's got termites? What if the market goes down? Like if you timeline this out, 2 years ago wasn't exactly the most, how can I put it, opulent time in Australia. It's not our strongest.
Australia wasn't looking going, oh my gosh, the economy's going to go great.
Yeah, there was a bit of fear in this market. And I think that's why we were able to secure this deal in the way we did, is because there was a little bit of fear around what's happening in the world. And I won't go into that topic, but just to set reference points. So like there were risks everywhere. But I elected that and this is a personal view of mine, is that number one is like, how do you mitigate all these risks to this point? Is number one, insurance. Like you're not going to not have insurances around these things to protect yourself. Number two is cash solves a lot of problems.
Yep.
So we were very fortunate that we did have cash because we did need that. You've seen numerously that I thought we were going to have to spend about 120 grand to get into this property, maybe 150 with all the other costs. It ended up being like near 220. So if you're not in a position where you have buffers like that around or available to you, then you really have to consider if you want to approach doing these types of things. Maybe
Definitely.
different types of property investing or other investing are appropriate to you. Next one that comes into it is like vacancy risk. So like what if, you buy the house and you find out that all the tenants are like they're running a meth lab? You don't know. Like I hope not. But you do your best on the due diligence there. But all the tenants were fine, by the way, and fantastic. But the point I make there is like there's tenant risk, and if tenants leave. So again, cash really solves that one, because if you can hold the property vacant for a few weeks or months, then that is a really easy one to go with. And then the last one I'll make here is community. So I had people in my corner like Aaron, Goose and Gabby, and then also my accountant helping me walk through how we do these things. So I had people in my corner who had crossed this path and were able to kind of give me insights and mitigate some of these things as well.
And I think that is the key, is understanding. And the more assets that I purchase, the bigger my list gets of things just to look out for. Just go, okay, these things can definitely happen. But also not just going, there's too many risks, I'm not going to take an action. And you said it's perfectly. It's like having the mitigation to the risk. Just because the risk's there doesn't mean you shouldn't do it. It just goes, okay, cool. There could be a lending risk. That's why I've got Aaron. Aaron, what happens if these situations pop up? It's like, yeah, I've seen these before. This is what we're going to do. This is what we're going to do. Great. Thank you. All right. Anthony, accountant, what happens in this event? Or, hey, now I need to try and increase my borrowing because I'm trying to achieve this. What can we do? Right? So there's so many different ways to leverage the team around risk mitigation.
So, and again, I had to give you one more around. There's a risk in doing nothing.
Oh,
That was more of what I was concerned about at this point. I'm like, okay, well, this could all go backwards. Like this could be the worst thing I ever do. I kind of like mentally prepared. I was like, okay, if you buy this and it doesn't go well and you have to fire sale it, what do you think is going to happen? You might lose 100 grand, let's say. Like, all right, cool. Even 200, let's go this up. I'm like, can you recover from that at this point in your life? I'm like, yes. Okay. Other side of things, if you do nothing, you potentially haven't lost this 200 grand or 100 grand. But it's like, what happens then? And I'm like, I'm a bit more concerned about that at this point. I think that if there's a time to make mistakes, it's now. Like this is going to be learning, like business is learning. Just like in the early years of business, I did some dumb shit. It's probably not going to be any different here. And there are still many more stories to come of just, again, there's other things we've done I'll mention in other dissection episodes. But I look at it now and just go like, people often are scared to take action, not realizing they should be more scared about not taking action. And I don't mean to say that in a way that would push people to like take unnecessary risk or go too far. But in my case, like I felt appropriate, and I felt like with the risk mitigation measures I'd put in place, I felt okay doing it.
It is an interesting one where people never factor that in. They never factor in the inaction, right? The compounding effect of just not doing anything. And a couple of questions just before we wrap up. So you've gone through this. This was one of your earlier properties, as you shared. What did you do different after that one? Like, did you say, that's it, I'm running away from triplexes, that these things are way too complicated? Did you never bank with that bank again? Was there anything else that you're just like, no, that's it. The fundamental way about how I approach this is going to change? Or did it reinforce your previous beliefs of saying, this is the right course, this is the way, as the Mandalorian will say, I'm just going to progress this way?
The positive, I think this was still a great learning experience in many ways, and the results of this property tell me it was worth it. So would I change doing it? No, I would absolutely do this one again. I think it's been a fantastic one in the portfolio so far, and I realise over the long term time will tell, but I'm fairly confident based on how it's all going so far. The other side of that, though, is what did occur out of this is it kind of slowed me down on getting into my next property.
Yep.
So I think I would have put more consideration into, like, if we go knowing what I know now is like, was that the right type of asset for that time where we potentially could have moved quicker if we picked, just standalone single family houses. And I think you have to elaborate that at portions in your portfolio where it's like you can get stuck if things like this come up and you can't come up with more funding or capital or a property or like I did a development which took like 12 months to do, and you get stuck for a duration of time. So forward thinking to what comes next is probably the thing I didn't have the awareness to that I gained from doing this one. This is something where I'm like, I'm never just thinking about what's next. I'm thinking about what's after that now and any consequences that come from it.
Yeah, such as the ability to refinance 6 months later or 12 months later, where you say, great, it's going to be a short-term impact of that 10%, which is what you refer to, which is $60,000. But I know that I can get that back out because I've got someone like Aaron in my corner. It's just going to be like, no worries at all. Short-term this, long-term, that's where we're going to go. And you go, easy. Okay, that's an easy decision.
Absolutely.
And so looking through this to sort of summarize, so we talk about like wealth concepts, and we've done an episode on that previously, which anyone who's playing at home can actually go and get access to that episode. It was episode 4 where we talked, episode 4 was wealth goals. Episode 5 was where we talked about core wealth concepts. So I'm just going to walk through a couple. So it aligns to your wealth goal, 100%. It aligns to inflation because you've got the positive of the inflation where you have debt over a period of time decreases in value as
absolutely. Yeah, using debt in this one hugely because of, even at 70%, like that's still a massive amount of dollars to deflate away. Yes.
And you've also got the cash flow coming in every single month, which is new money coming in, which is not being impacted by the inflation of the rent is increasing as well. So you're getting both. I
love this analogy. It's a self-sourcing pudding, all right? That's what it is.
It's a lava cake, rather. You've leveraged. So you've used debt in your advantage. Here you had obviously a 30% deposit with a 70% loan. Obviously, ideally at 20/80, which is where you got to, 20% deposit, 80% loan. So you've definitely used leverage to make sure that you're getting the returns today and not trying to save that $620,000 in cash and then trying to purchase it as well. You've leveraged time. Like you've had this for 2 years and beyond, like your future strategy was, I'm just going to hold this for the moment. And it might get a point where I might sell it or sell another property to pay it off or whatever it is. But you've got that time that is on your side. You've definitely utilized tax. You've talked about how the initial $5,000 that you spent to do the improvements, the doors and all those kind of things, well, you were able to expense that under the property with the cash flow that was coming through. But you've also utilized your business from a tax perspective, right? So you've use your income to prove to the banks that, yes, I am solid and I can borrow, notwithstanding that they don't like triplexes, but that's fine. To say, yep, I can borrow up to $1 million. You've leveraged team. You used Goose and Gabby from Dashdot. You've used Aaron from DNF or Diagnostics and Financials. And you've used Anthony from Trover Tax. And then you've also had risk mitigation, noting that like most things in life, there was an issue that popped up that you weren't aware of or a risk that happened that you go, I didn't expect this to happen. But the business has been a vessel that has helped you mitigate that risk as well. And the team around you has supported you in saying, like, this is what we can do. It is just going to be a bit of a short-term pain for a long-term gain. From my standings, it looks like it ticks most, if not actually not even most, it ticks all of the wealth concepts. Is there anything you wanted to add to that or anything you think I might have missed on it?
I just hope people can see how they've been layered together, like bringing all those concepts and goals and things together to achieve, in this case for me, this might not be a successful investment for you. Might be too small or too big or you need something different. But in my case, this ticked my goals and ticked the boxes with all these concepts to get progress towards what I'm working towards. And different properties and different dissections will be different. I just want to put on the end of this as well, by no means is this financial advice. By no means are Grant and I qualified in any way to pick properties or suggest things. I just wanted to share it so people know what is possible so they can seek professionals and start this education journey themselves.
Yeah, and it's a really good point that you mentioned as well, because the whole point is for everyone who's listening to this to be part of our network, to be part of our peer group, to understand like this is what we've been able to achieve. This is what you can achieve as well. And so I think in future episodes, as we're dissecting our best investments, we'll make sure that we've got some of the more affordable ones in there. We'll make sure that we've got some more of expensive ones. So anyone who's listening to this, no matter what stage or level you're at, you can go, I relate to that. Oh, I understand that. I can aspire to get there as well. So if you have enjoyed this and you do have any questions that we haven't looked at, now we've tried to dive into absolutely everything here, look under every single rock. And you do want to ask us any questions, or you did have any other insights that you want us to provide to you, head over to Facebook, join the Asset Blocks community. So just go into Facebook, search for Asset Blocks community, and join the conversation. Ask Charley or myself any questions, and we'll be more than happy to share either there or even do a podcast episode about it where we can dive deeper into it. And if you did enjoy the show, be sure to subscribe or even share it to someone else that you say, hey, it is possible. Maybe we can get on to this, whether it's a partner or another friend, etc. Because that's what we're about. We just want you to see and learn from what we've done and our stories that we're sharing. And thank you again for joining us, and we look forward to catching you in the next episode of Asset Blocks Business Owner Edition.